Peter Dixon is a global equities economist at Commerzbank. He joins us from the company's London headquarters. He doesn't think QE with a twist will work. And here in the studio, I'm joined by Tom Vosa, who's head of market economics at National Australia Bank. So thank you, gentlemen, for joining us. Tom, let's start with you. Why do you think Operation Twist will be effective?
Because the central bank has two problems. It needs to reduce the cost of longer-term debt in order to give money into homeowners, the mortgage market, which is largely priced off 10-year bonds. It also needs to increase short-dated interest rates, because right now everybody's keeping money in the overnight market, and that's really jamming up the banking system. The interbank stresses we have is having kept rates low for so long and having signalled that they are. Interbank rates are close to zero. Everyone's keeping money in the overnight. Banks cannot get term funding. Lifting short-term rates, pulling down long-term rates, basically starts to unglue the banking system whilst giving money back to homeowners.
All right, so let's get your thoughts on that. Peter Dixon, is Operation Twist going to be any sort of game changer for the US economy?
Game changer, certainly not. I mean, over the course of the last 18 months, 2 years, we've seen an awful lot of liquidity pumped into the markets by the Fed, and I certainly accept what Tom is saying about ensuring we can raise short-term rates a little bit. But the fact of the matter is that you can lower long rates as much as you like, and in an environment where the banking sector really isn't in a position to lend on any additional cash it gets, in an environment where lenders, borrowers, are not in a position to take on more debt, it's questionable that additional monetary stimulus will actually give the boost to the economy, which I think many people are looking for. That's not to say don't try it, but I just don't think we should be too surprised in the long run if it doesn't work.
OK, so Tom, what are your thoughts on that? You can lower rates as much as you like, but effectively you still have some deep structural problems. You have a depressed housing market, you have high unemployment. Operation Twist isn't actually going to do anything to address these fundamental issues.
Well, of course, if we can reduce the cost of people's mortgages, they will have more money to spend, and we'll start getting an effect from that. Now, the Fed has about $134 billion worth of short-term assets. If it sells those, we should see 10 basis points off 10-year gilts. Now, if they're at, 10-year bonds, if they're at 1.95 at the moment, not an awful lot. What are we looking at? A 5% fall in rates? Not much, but it's going to help at the margin. The other issue, of course, looking at unemployment is, again, if we get that spending going through, the labour market is improving. Layoffs are within the historic norms. I think the US economy underlying is in better shape, and therefore the marginal impact may be higher.
So what do you think about that then, Peter Dixon? It's, when the situation is so, I suppose the risks of recession, or the fear is certainly there, even a marginal difference, even if borrowing costs were to come down a little bit, reduce borrowing costs for homeowners, boost investment potentially, and possibly more borrowing, even if the difference is a very small one, that it is nevertheless significant when the situation is so fragile? Oh,
yeah. I mean, obviously, the Fed has to be seen to be doing something, and I think that what it can do, what it's doing, like it to do today, I should say, is to engage in a policy which doesn't actually mean an expansion of the balance sheet. So it's seen to be doing something which in turn I think will help to secure market confidence. That's a good thing. So I think the object of this policy is to be seen to be doing something without actually committing itself to a massive monetary expansion. In that sense, it's a classic do something whilst really doing nothing policy.
All right, so Tom, what about the risks of this policy, the risks of recession, forgive me, the risks of inflation? Is that still something to be thinking about? Is that something to be wary of?
Well, clearly some FOMC members do. We've had quite a lot of dissension on this, and some would not like to see an expansion in asset purchases precisely because of that risk. I have a think, given that global growth is above trend, and given you can argue that previous QE only inflated commodity prices and so reduced real incomes, there are some issues that if you just increase asset purchases, you do a bit more coin clipping, that actually the effects you're getting aren't going to work. That's obviously a risk, but we have a US economy at stall speed. We have a world in which everyone has lowered their duration. We need to extend maturities out. We need to get people looking at a year ahead, 2 years ahead. That starts to generate investment. We need to move beyond, at the moment, in a global economy which is only looking a quarter ahead to at least a year. That starts to get investment growing.
Peter Dixon, economists are very divided still over the effectiveness of Operation with a Twist. So, I mean, tell me, the idea, I suppose, is that many are saying inflation won't be such a risk because the Fed isn't actually expanding its balance balance sheet, it's all about the composition of its balance sheet. You're exchanging short-term debt for long-term debt.
Yeah, I mean, that's absolutely right. I mean, I think this inflation story is a little bit of a red herring at this stage. I mean, as Thomas pointed out, the economy's flat on its back. It's not going very far. If we are seeing a recovery at the moment, it's a very, very slow one. Inflation is a problem for way down the track. And, let's be fair. I mean, the world is heavily indebted. The one way in which we can reduce the debt burden throughout the global economy is to generate a little bit of inflation. So I think we shouldn't overdo the inflationary aspects of this policy at all.
Tom Vosa, a little bit of inflation is a good thing.
It is at the moment, and that's historically how, of course, governments have always defaulted on their debt. But actually, the debt forgiveness story, if the Fed wanted to really be radical, it would start printing money and starting to forgive mortgage debt to get the housing market going. And that way, we'll start to see more migration through the US, and that will start to sort out the labour market. At the moment, we are seeing jobs being created. They're not being filled. There looks to be quite a lot of labour market mismatch because of the gluing up of the US housing market.
Peter Dixon, is the Fed going to have to go one step further? You both seem to be in broad agreement that the benefits of Operation Twist are somewhat limited. So does that mean that we're going to have to see an all-out QE3 this year, if not the next?
Well, certainly, if it was down to me, I would be advocating, if we're going to do something on the monetary side, let's actually print some more money, as Thomas pointed out. Now, whether that's just, printing more money, buying more Treasury securities, it doesn't really matter at this stage, but just do something to try and float the economy off the rocks. I think we should also point out, however, that it's not all about monetary policy. I think fiscal policy has a very big role to play in this debate, and that's why I'm a little bit concerned that in many parts of the world, at least, not just the US, we're talking about monetary solutions to a problem which is at least partially a fiscal one.
OK, so fiscal policy, more needs to be done on that side. This is something that we've heard, haven't we, before, Tom Vosa? Needs to be more investment in infrastructure and so on. But I suppose that's easily said than done when you think about the political obstacles to this.
Well, if you can borrow for 10 years at 2% if you're the US government, then arguably there's plenty of scope for an investment project, because the returns on that infrastructure investment, all they have to do is generate you more than 2% per annum. I think there's plenty of scope for the US to borrow. The bond market, unlike Greece, unlike Spain, unlike Portugal, the US bond market tells you that the US is still AAA, even though S&Ps might disagree with you. I think there's plenty of scope for fiscal policy, should they be bold enough to take it.
All right, thanks very much indeed. Tom Vosa, Head of Market Economics Europe, National Bank of Australia, and Peter Dixon there of Commerzbank, Global Equities Economist. Thank you, gentlemen. Well,